Hello, traders and investors. My name is Roger Scott. I'm the head trader for WealthPress. Today is November 30th, last day of the month. December is here. We're finally at the last month of the year. Folks, I got to say, this year feels like a black hole to me. It feels like we started the year and then just kind of went through like I don't remember what happened, and now we're at the end of the year. It's really remarkable. But markets, they continue humming, moving, distracting us, making us money, scaring us, and doing all of those things at once. So let's get into it right now, figure out what the market's got in store for us, figure out where it's going to go, figure out what we have in store for us this week. So starting off with the news, this is going to be a fairly busy week. Remember, we're coming off a holiday weekend. I'm not expecting large hedge funds to get back into the market till about Tuesday, Wednesday. So don't expect a lot of volatility or volume. You may have a lot of volatility, but you're not going to have a lot of volume behind it. As far as the major news announcements this week, we've got Jerome Powell speaking. He's going to tell us how the economy is screwed and how he's not going to raise rates for the next few years. We already know that. The ADP report is going to be very instrumental. It's going to give us a good understanding of how the employment situation is doing before the major report. That's a Fed report that's coming out Thursday and Friday. So this ADP employment report gives us a good preview of what we can expect from the jobless claims. The biggest reports of the week is going to be employment situation and jobless claims. Why? Well, they haven't been doing well. We went from like 1.1 million to 750,000 new claims, and now we're back to about 800,000. We're not showing a break in the moving average. As a matter of fact, let me show you what we're expecting next week. Same thing here. If you look back, 4-week moving average, 748,000. The problem is, this is not becoming a 4-week moving average. This has become like a 20-week moving average. We've been down this road and staying at this level for a while. And if unemployment levels remain at these levels, it's going to impact into the economy. It's going to slow down the economy. It's going to definitely slow down retail sales, consumer discretionary spending, and so forth and so forth. So I'm hoping against hope, fingers, toes crossed, that we're going to break below the 700 level. Till we break below the 700 level, we're not going to get any growth in this economy. Now, something else I need to show you, and this is important. Put the call ratio is finally backed away. Market is backing away. If you look at the indices, you will see that the NASDAQ, the stay-at-home, is rallying again, and the non-stay-at-home is cooling off. Remember what I told you last week? I told you something very, very important. And I told you that the market is at a crossroad right now. It doesn't know which way to go. It doesn't know whether it should go back to normal. Vaccines coming out, we're going to go back to normal. Everything's going to be okay. Or we're going to go back to things are not normal. Unemployment data is slow. Their vaccine is not coming out fast enough to remedy the number of people getting sick and the number of deaths because COVID is ramping up again right now. So I told you it's a little battle between these two factions, and we didn't know which was going to win. And I told you it's literally we're at a crossroads. Right now, for 2 days now, for two trading sessions straight, the NASDAQ has been outperforming. And the NASDAQ 100, when the NASDAQ 100 is strong and the rest of the stocks are weak, the indexes are weak, the Dow, the S&P, that's telling us that the stay-at-home environment is winning. And I told you that may be the case because here's the problem. Even though the market discounts everything that's known, even though the market looks ahead, the problem is the number of these COVID infections is increasing so fast that even if the vaccine comes out beginning next month and healthy people start getting it in 4 months, it's going to completely derail the first quarter of 2021. And that means we're going to have another sucky quarter. And that means more downside, more economic turmoil on the jobless claims, more put to call ratio messing up. So that's the problem. So we've seen 2 days of that right now. If we continue going down this route, we are going to see again the same thing that happened last March, April, and May, except we're going to see it starting in December of this year. At least that's what the indices are telling me. So far, the stay-at-home is beating out. You could see here, because the non-stay-at-home is the Russell, the Dow, the S&P, the Nasdaq is to stay at home. It's been overbought, and again, it's coming off overbought territory. The S&P as a whole is coming off overbought territory. But again, as of right now, with what I'm seeing, people are more afraid of COVID and what it's going to bring than they are hopeful of the recovery. So again, it may change, but now for the last 2-3 sessions, that's what we have seen. All right. Now, as far as the overall market is concerned, global shares turned lower on Monday as investors took a breather after pushing Wall Street to a record high last week on hope that the vaccine will come out. The economic outlooks remained mixed, however. While the U.S. and Europe remains hobbled by high rates of infections, China's economy is growing after it's managed to rein in the pandemic. Do you guys remember what they were doing? They were like spraying the whole city with bleach at night to get rid of. I mean, they took some serious precautions. Purchasers Managers Index, or PMI for China, showed its manufacturing sector was growing. And that's very, very important because what happens? That impacts the exports coming into the U.S. and that impacts all the little gadgets, all the little technology stuff that we make here, but the parts are made in China. Remember all those things you were trying to buy on Amazon March, April, May of last year and they weren't available? That's because the Chinese couldn't get their parts here. But now it looks like their manufacturing is growing, and they're not just saying that. I could see it because I could see all those things that were totally sold out on Amazon, like microphones, speakers, headphones, webcams. They're all available now. In corporate news, shares of IHS Markit was up 6% after SP Global said it was buying data provider in a $44 billion all-stock deal. That is a surprise. OPEC nation, watch out, crude oil led by Saudi Arabia will meet virtually on Monday over Zoom, I bet. I couldn't hesitate to say that. Once again, to decide once again how much oil their members should produce as lockdown relates to COVID, still demand for crude. Reflected to the COVID stifled demand for crude. They're expected to extend the production cuts well into New Year in an effort to boost volatile oil prices. And look, the group has to reach an agreement amongst its members and countries and the additional members in the group known as OPEC plus Russia. And crude oil's finally is getting above the price that U.S. frackers pay for crude oil. They pay about $43 a barrel. Now it's at $44.88. So frackers are finally starting to make money on crude oil again. And on that note, let's take a look at the energies market. Let's see how it's doing. Let's take a look-see here. Down a little bit. Yeah, I am not bullish on the energy market, not at all. But again, let's take a look. Over time, things change. Yeah, it's just crossed the moving average. I would be very, very cautious. I would not go long the energy market till it took out the 60, let's see here, this level right here, the 66, 67 level. Until it hits that 67 level, I wouldn't be a buyer. And it's been sitting there for quite some time, as you could see here. So this thing peaked 2 years ago, literally 2 years ago. There is a lot of supply right now. It's good that we're moving above the 50-day moving average on a weekly basis, but we're still below the 200-day moving average on a weekly basis. So you're going to have to be very, very cautious and be very careful with oil. And my suggestion would be to put your money in a fund like this, the energy sector, because it has evergreen, it has non-traditional energy stocks and traditional energy stocks at well. And that, if you look at the constituents here, you'll see it's got a little bit of everything here. ONEOK, Halibut, Hess, Marathon. So again, Chevron, Schlumberger. The energy sector is better if you're going to buy it for long term. I wouldn't put it into an individual company because the downside is a lot further. Now, looking at the sectors, industrial, basic material, financial is leading. Look at consumer discretionary. It's in fourth place, and technology is now behind energy. That's bad. This is not good for the stay-at-home sector. This is good for the getting out sector. Usually industrial, basic material is telling us that things are moving forward, not moving backwards. If technology was leading, then it would tell us that stay-at-home stocks are moving higher. But the problem is, if you look at the futures on an intraday, on a short-term basis, that's exactly what's telling us. So again, the market is really confused right now. On a longer term basis, on a weekly basis, it looks like we're getting out of this mess. But day to day, it looks like the markets are afraid of the stay-at-home, going back to the stay-at-home environment. Let's look at the NASDAQ 100 to see what stocks are leading. It's only a matter of time till the stay-at-home stocks are going to be leading again. Yeah, Zoom, Align, Expedia. It looks a lot more mixed right now. And that's the problem I'm seeing. The markets are mixed right now. We're kind of in between. We have a lot of uncertainty right now. We don't know, as I said last week, we don't know if we're going to go this way or this way. And I'm getting mixed signals. The longer term data and the cumulative data, as I showed you, let me show you here, the 10 major sectors. The cumulative data, longer term data, is telling us that industrial, basic material, and financial are leading, which is the going back out, the non-COVID fear. But if you look at the put to call ratio, it's overbought. And if you look at the indices, the stay-at-home indices are rallying, the NASDAQ 100. So again, the markets are a bit confused, and I think they're going to stay that way for at least a few more weeks. We're going to see a little fragmentation. Again, we need to see the number of COVID infections cool off, because the rate of the infections that they're increasing is telling us we're going to go back to a closure. California closed down again, so we got to be very, very careful. We have these two trends right now developing, and the market does not, and I'm serious right now, the market does not know what to do. This market doesn't know if it should go back to the stay-at-home environment or to the get out and have fun and play and expansion. It doesn't know. It's kind of doing this right now, and every day makes a difference. So we have to be very, very cautious right now, because till the market straightens out, it's going to be very hard to figure out where to trend. So you got to tread very, very carefully, go for very short-term trades, and have very tight stops. And also remember, last week was a holiday week, so expect some fragmentation and low volume possibly till about the middle of this week. I think by the end of this week, we're going to see which trend is prevailing. But right now, we still don't know if the stay-at-home environment is going to prevail for the next 2 months or maybe more, or if we're going to continue getting out of this mess. It's touch and go right now. It's touch and go right now. And again, we're seeing conflicting info on the sectors. We're seeing conflicting info on the stocks that are, or the sectors that are leading in the mornings. Things are mixed right now. And when you add on top of that the holidays, and when you add on top of that the low liquidity and the mixed commodity markets, this is not a time to be a hero. This is a time to be very, very careful, to be very cautious, because we don't know what is going to happen. We don't have a very strong degree of expectancy of where to go right now. And folks, I'm going to be honest with you. Most of the time, I know how things are going to play out, but I'm doing this right now. I'm doing going left, going right, going left, going right. And we're having really mixed signals at that right now. And again, I'm not trying to be a hero and tell you I can predict the market at all times. It's my job to also tell you when things are getting a little choppy. And right now, things look very, very confusing. It's not going to stay that way for a while. But again, we're battling the tale of two evils. Whether COVID spikes like crazy and we just can't do anything about it and we give up for the next quarter, or the market can overcome that because we know that the vaccines are coming and eventually we'll get out of this in the next few quarters. It's literally a tale of these two stories. And till we get out of it, till we have clarity, you got to be very, very, very careful. But I got a way to help you right now in this market, in this environment we're in right now. I've got something you've got to see, and it could give you a chance to earn 339% every single week, regardless of what the market is doing. As a matter of fact, we just took almost a 400% profit on Friday on a trade very similar to what I'm talking about. And we had that trade on for like 3 days or 4 days. When COVID-19 first started to surface and people were stuck at home, a surprising large number of them took up casual trading to the point that a no-fee trading app amassed over 13 million users, and this trend is continuing right now. Even though many of these traders may only have a few $100 to trade, the sheer numbers, the sheer combined numbers of them meant that billions of dollars were flooding the market every single day. Remember, their orders get bunched together. So you got 100 guys pressing a button, placing 10 trades, their orders get bunched together, and when the order comes through, it's a huge trade. So when enough traders jumped into a particular stock, it jolted it. I mean, it really, really jolted it. I call this the Robinhood effect, and it's still happening right now, and folks, it's not going anywhere. Now, I don't want you to be left out. I need you to click the link below to see how you could take advantage of this Robinhood effect right now. Folks, do it now. Don't delay. Take advantage and figure out a way to succeed even when markets are confusing, stagnant, and trading bidirectionally. There's a way I can help you get out of this mess sooner than later. Algorithms and Robinhood, this is the way to do it. I'm telling you, folks, the momentum we've seen from these stocks, I haven't seen in years, even in these type of market cycles. You don't want to miss this. Check out the Robinhood effect. Click the link below. Take advantage of it right now. And I'll talk to you guys soon. Give me some comments. Like this video, and I'll talk to you guys soon. Have a great day. Bye.